Christmas bells are going to be ringing, and as the year 2025 comes to an end, here's bringing some thinking out of the box for taxpayers who are earning capital gains. There are situations where you may have incurred short-term capital losses from equity, which fall under the category of Section 111A, which prescribes a tax rate of 20%. And on the other hand, you have potentially earned some gains from, say, non-equity mutual funds, debt funds, money markets, etc., where under the deeming provisions of Section 50AA, such gains are to be treated as deemed short-term capital gains, but which can attract tax of up to 30% if you are in the top bracket. So it's about 2030. We all know 2020, but today we are going to talk of 2030. And a very interesting poser that comes up, let me start straight with an illustration. Say for example, you have short-term equity loss of 10 lakhs of rupees, which you have incurred during this year or which is carried forward. And reciprocally, there is a 10 lakhs of gain under Section 50AA required to be taxed and treated as deemed short-term capital gains, as if they were short-term capital assets. The question is, can you set off this 10 lakhs against the other 10 lakhs? 10 lakhs of the 20% family against the 10 lakhs of the 30% family. Before we take up the answer, let me invite your kind attention to the provisions of Section 70, subsection 2 of the Income Tax Act, which provides for inter-head losses. And Section 70, subsection 2 states that any short-term capital loss can be set off against any capital gain under the head. It could be either short-term or even long-term. We are all aware about that. But the question here is, there are differential tax rates. Short-term capital loss of 20%, short-term capital gain of 30%. Tribunals, friends, have held, and fortunately there is also a support that we can draw from a very old circular of the CBDT of 7th July 1955. In fact, CBDT at that point of time had said that where there are otherwise no restrictions, what should be the manner or the choice of set-off of losses against gains should be the decision of the taxpayer, and he can take a call on that. A number of ITAT decisions have also held categorically that revenue cannot take exception against the fact that a taxpayer is going to gain because of these differential tax rates. As I explained to you, 10 lakhs at 20%, you have a potential 2 lakhs of tax, element involved in the 111A, equity loss. And as far as the 50AA gain is concerned, on 10 lakhs, you would be required to pay otherwise 3 lakhs. But if the 10 lakhs is set off against 10 lakhs, your effective tax liability is 0. However, can the department say that, well, you should be entitled to 2 lakhs of tax benefit against the 3 lakhs and you pay 1 lakh? The taxpayer would obviously want to take the advantage of that unintended but lawful tax saving of rupees 1 lakh. The answer is very clear. The provisions of section 70 subsection 2 do not prohibit, and when these provisions were made, nobody had contemplated 20%, 30% and those scenarios. Sometimes it could be the other way around also. But the provision is very clear. You have a short-term capital loss, you can set it off against a short-term capital gain. So friends, enjoy your Christmas or even the New Year. If you are going to have situations where you want to take this benefit of 2030 in the manner that I have explained.